In this video, we're comparing two entertainment giants that have shaped how the world watches TV and movies, but with two very different stories. Netflix is the modern disruptor, the streaming pioneer that changed how we consume content, while Disney is the century-old storytelling empire. And I've built detailed 10-year valuation models for both stocks, and in this video I'll reveal my fair share price, final star rating, and projected annual return to find the real winner. So streaming isn't just entertainment anymore, it's a global cultural force, with billions of hours watched every week. And the fight for your attention is led by these two giants. First we have Netflix, the first mover in subscription streaming with over 270 million subscribers worldwide and a relentless focus on content, tech and personalization. From global hits like Squid Game to Oscar-winning films and my own personal favorite show of all time called Ozark, Netflix is all in on being the streaming platform of choice. And here we can see a quick snapshot of how Netflix has performed over the past year. We can see that revenue has grown and so has EBITDA at a higher rate. And today the company has an EBITDA margin of 67%, one of the highest EBITDA margins I've ever seen. Now the current share price has risen by over 80%. Now this will become an issue later on in the valuation, and the company is headquartered in California in the United States. And then we have Disney, the house of Mickey, Marvel, Star Wars, Pixar and ESPN. Its Disney Plus streaming service has exploded onto the scene, but Disney is much more than just streaming. It has theme parks, cruise lines, merchandise, TV networks. It's an entertainment ecosystem that can monetize a character across decades and mediums. And here we also have a quick snapshot of Disney's performance over the past year. We can see that revenue has grown by just 3% and EBITDA has actually grown by close to 21%, and today the company has an EBITDA margin of 16%. Now the current share price has also risen by 35%, and the company is also, just like Netflix, headquartered in California in the United States. So the bull case for Netflix is quite clear. First of all, we have global scale. Netflix's massive subscriber base and brand recognition give it a head start in nearly every market. In addition, it's a content engine, a proven ability to create global hits that work across cultures. And lastly, we have operational efficiency. We have strong margins with pricing power, and password sharing crackdowns are boosting revenue. Now, of course, there is a bear case as well. First of all, we have valuation risk, which we'll talk about later on. The company is trading at a rich premium, and the market is pricing in years of strong growth. In addition, we have slowing subscriber growth. The easy expansion phase is over, and future growth will be harder to win. And lastly, we have content spend pressure. Maintaining its edge requires massive ongoing investments. Now we also have a strong bull case for Disney as well. First of all, we have an unmatched IP portfolio. No other company owns such a deep and beloved set of franchises as Disney. And we also have diversified revenue. From theme parks to ESPN, Disney has multiple income streams beyond streaming. And lastly, you could say we have a discounted price as well. The market seems overly pessimistic, leaving upside if execution improves. But as we saw with Netflix, we also have a bear case for Disney as well. First of all, we have streaming profitability challenge. Disney Plus faces pressure to reach consistent profitability. In addition, we have linear TV decline. Cord cutting is accelerating, hurting ESPN and other channels. And lastly, we have execution and debt. Recent acquisitions and investments mean higher debt and more execution risk long term. Now, as we later on will do a head-to-head valuation for both stocks, let's start off by looking at some historical data that we have going back 5 years in time. And here we have Netflix and their core financial performance, and here you can see revenue in blue and you can see EBITDA in green. Now we can see that revenue has grown by 12% on average per year, and at the same time EBITDA has grown by 14%. So the company has become much more profitable in the recent 5 years, and this is also reflected in the EBITDA margin. It was 62% in 2020, and in 2024 it grew to almost 68%. And here we can see basically the same chart for Disney. We can see that revenue has grown by 9% per year on average, and EBITDA by 30%. So that's higher than Netflix, right? And this is showing us that the company is becoming much more profitable, much more efficient, and it's basically executing on its long-term strategy. Now, another interesting chart for Netflix has to do with the debt sustainability within the company, for us as investors to measure if debt is any risk for us going into the stock today. Now, here we can see that debt has declined by 1% on average per year. We can see it declined the first 4 years, and it kind of re-accelerated slightly in 2024. Now, excess cash has basically done the same, right, declining by 1% per year, but we've seen in the past 2 years, right, that excess cash has grown significantly all the way up to close to $8 billion US. And here we can see basically the same chart for Disney. We can see debt that's actually going down every single year, right, as the company is paying down its debt, and the excess cash is also going down, right, as the company is using its cash to pay down its debt. Back in 2020, the debt to EBITDA ratio was 8.6 times, much higher than the 3 times that I'm targeting, and today the company is finally below that at 2.9 times, showing that debt is no longer as big of a risk as it was just 5 years ago. Now, as we later on will use the free cash flow in our valuations, let's also take a look at the free cash flow to equity performance. That's the relevant free cash flow for us as investors for Netflix. And here we're also comparing it again to revenue, right? So the free cash flow hasn't been as consistent as we saw with EBITDA, right? We have a negative year in 2021, and that's in line when the stock actually got hammered in the market. And since then, the company has done a massive turnaround, right? Generating over 8 billion in free cash flow just in 2024. And here we can see basically the same chart, but for Disney. And here we are also comparing it to the revenue, right? And we see kind of the same story as we saw with Netflix, right? That the free cash flow is much more inconsistent than the company's EBITDA, right? We see 2 negative years, but the good news, right, is that the company is turning around. We can see positive numbers for 2023 and almost 6 billion in free cash flow to equity in 2024, which is a great sign for investors. Now, the final chart I would like to show you for Netflix has to do with the company's share performance. Now, this is across 2 dimensions. We have the share price as the dotted line, and we have the number of shares outstanding in the company as the blue pillars. Now, we see that the share price has risen right in 2024, and at the same time, the company is actively buying back stock at 1% per year, which is a great sign for investors. And here we can see the same chart, but for Disney. Now, the differences are quite interesting. First of all, we can see that the share price has not recovered at all, right? Now, the number of shares have also kind of stayed flat, as the company is not prioritizing buybacks as Netflix is doing and focusing more on paying down its massive pile of debt. Okay, so now we've looked at some historical financial data. Let's move on to the exciting part, which of course is the valuation part, and we'll start off with Netflix. And as always, just to be fully transparent, let's start off by going through my assumptions for Netflix in my valuation that I'm forecasting all the way up to 2034. So that's 10 years including 2025. Okay, so let's start off with the average yearly revenue growth that I'm forecasting, and I'm forecasting 11% per year. That's slightly lower than the 12% we've seen in the past 5 years, but the company is of course much larger. It will be harder to keep up with growth. Now, in terms of EBITDA margin, I'm assuming 70%. In the past 5 years, it's been 64%, but the company is at 67% today, so 70% isn't really that unrealistic in my opinion. And in terms of enterprise value to EBITDA multiple, I'm assuming 10 times. So that's a slight compression in multiple as growth will eventually slow down in the coming years. Okay, so let's move on to my free cash flow assumptions as well. So here I'm assuming 13% yearly growth rate on average. Now that's lower than the 34% we've seen in the past 5 years, but it's still higher than revenue growth. So assuming that the company can still keep expanding its profitability. Now, in terms of free cash flow yield, that is how much free cash flow we get relative to the share price, I'm assuming 3%, so higher than the 1.2% in the past 5 years. And finally, the discount rate I'm using to discount future cash flows to a present value of today, I'm using 12%, which I think is realistic for a company like Netflix. And using all of those assumptions, here you can see an overview of the revenue and the free cash flow that I'm forecasting for Netflix all the way up to 2034. Now, you can see that the growth rates are of course higher in 2025. That's in line with the company's guidance. And then I'm basically decelerating both revenue growth and free cash flow growth all the way down to 2034. However, I assume a slight spike in 2026 as their AI investments and focus on other types of content like sports, etc., and games as well will materialize in the near future. Okay, so if we discount all of those future free cash flows that I'm assuming in my model, we get a fair share price for Netflix of today at roughly $864 per share. Now, if we compare that to the current share price, we see that the stock is trading at a 39% premium currently, and we get an implied annual return at just 8% per year, so that's in line with the overall market. And I think this actually kind of makes sense. We see that the stock price has risen by over 80% in the past year, while EBITDA has only risen by 22%. And it's that discrepancy, right, in the growth in the stock versus its internal financials that really creates this discrepancy when we really take a look at the valuation of the company. Now, given the premium the stock is trading at today, the best I can do for the stock is a hold recommendation and a final star rating of 3.5 out of 5 stars. Okay, so let's move on and look at my Disney valuation, see how the company compares with Netflix on a valuation basis. And starting off yet again with my assumptions, here I'm assuming revenue growth at 8% per year, so slightly lower than the 9% we've seen in the past 5 years, and the EBITDA margin I'm assuming is at 18%. So that's much higher than the 13% in the past 5 years, but currently in 2024, the company had an EBITDA margin of 16%, so it's not really that much higher. Now, in terms of enterprise value to EBITDA multiple, I'm assuming 12 times, but also assuming that the company will slow growth and improve its profitability at the same time. Now, in terms of the free cash flow assumptions, I'm assuming 11% free cash flow growth per year in the coming 10 years. That's of course much higher than the negative 19% we've seen in the past 5 years, assuming that the company can turn around its profitability and free cash flow. Now, the free cash flow yield I've set at 4%. That's higher than I did with Netflix, and in the past 5 years it's only been 1%. So I think that makes sense given the multiple and given the growth rates we have for Disney. And finally, the discount rate that I'm using is 11.9% when discounting the future cash flows to a present value, and that's in line with the 12% I used for Netflix as well. And using all of those assumptions, here we can see the forecast for revenue and free cash flow all the way up to 2034, and I've applied kind of the same logic as I did with Netflix, right? So I'm assuming the growth rates that the company has guided for 2025, then a slight acceleration right in 2026 as the company becomes much more operationally efficient, and then I'm basically decelerating both revenue and free cash flow growth all the way down to 2034 in order to stay conservative. Now, if we discount all of the future cash flows in our forecast to a present value of today, we get a fair share price of $144.5 per share. And this is interesting because if we compare the current share price with our fair share price, we can see that the current share price is trading at a 19% discount. We also get an implied annual return of 12% per year. And this is telling us perhaps that a company with a much lower valuation is offering a much larger opportunity for new investors wanting to own the stock long term, at least on a valuation basis. Now, in terms of recommendation, I'm still giving the company a hold rating, and my final star rating is 3.5 stars. If you're enjoying this video so far, feel free to drop a like or subscribe or check out my channel. It really helps out. Now, a great stock, in my opinion, isn't only a great business or that it's well priced in the market. It also needs to have momentum. So let's take a look and see if Disney or Netflix both have momentum in the market right now. And starting off with the stock chart of Netflix over the past few years, I think the answer in terms of momentum is a strong yes. We can see that the stock price is rising. The stock has risen by 80% in the past year, and investors are giving credit to the amazing profitability that Netflix is producing. And zooming in a bit, we could argue actually that the stock might be a bit overextended. There is a big gap between the current share price and the 200-day moving average, and it's soon September. That's the most bearish month for the market in the year, right? So there's a risk that the stock price could correct itself down to the 200-day moving average. Now, if you'd like to wait and see if you can enter Netflix stock at a lower price, here you can see what happens to the annual expected return if the stock price goes down or if the stock price goes up. And if you would like market beating returns, which is 13-16% per year, right, then the stock price has to go down by 30 or 40%. I'm not sure how realistic that is, but that's the case at least on a long-term valuation basis. Now, taking a look at Disneystock chart, we see a completely different story. We see a stock price that has indeed risen in the past year, right? But if we compare with the prices we saw in 2021 or early 2022, really the stock hasn't recovered at all. And if we take a closer look at the stock chart, the stock has kind of followed this horizontal trend line. I think currently if the stock continues to perform with its technical performance and financial performance of the company, then there is a huge chance that the company could break above and hopefully in a few years reach a new all-time high. And as we did with Netflix, here we can see what happens to our annual expected return. So we're currently at 12%, but if you'd like 14-16%, then yeah, the stock has to go down by 10 or 20%. And that's of course totally realistic. So it depends basically on the expected return that you'd like for your portfolio when investing in Disney. Okay, so now we are at the end of the video. Let's see who wins this head-to-head. So in terms of historical revenue growth, it's obvious Netflix is the winner in that category. Now, in terms of future revenue growth, I'd say Netflix takes the win again. And in terms of profitability, I'd say Netflix is the winner here as well. Now, in terms of expected annual return, we saw in our evaluations that Disney is the winner in this category. And this is also the case when comparing the current share price of these stocks with our fair share price targets. And we see Disney is also the winner here as well. So the final winner in my head-to-head is actually Disney. Even though Netflix is the stronger company from a business point of view, Disney's valuation offers more opportunity for new investors to enter the stock today. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get a free one-page here which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.